Welcome. We're about to dig into why the 2026 market is shaping up to be one of the most unusual we've ever seen. And it's not just about things happening to the economy, it's about what's changing deep down inside it. Let's break it all down. So, let me start with a big question for you. For years, we've all been trained to watch for external shocks, right? Things like elections, geopolitical drama, a surprise move from the Fed. But what if for 2026, the biggest risks aren't coming from the outside at all? What if the real story is a fundamental rewiring of how our economy actually works? And that brings us to a really important idea for 2026, the difference between instability and good old-fashioned uncertainty. You see, uncertainty is like driving in a fog. You just can't see what's coming. Instability, though, that's when the road itself starts to buckle and change shape underneath you. The old rules are breaking down, and that's the new, unstable ground we're all trying to navigate. So here's our game plan. First, we're going to define this new kind of market. Then we'll look at two absolutely massive trillion-dollar engines that are powering all this change. We'll also dive into a huge problem that could put the brakes on the whole AI revolution. After that, it's a sector-by-sector showdown. Who wins, who loses, and finally, we'll hunt for where the real opportunities might be hiding. Okay, let's jump right in. First up, this is not your parents' market. We are living through a massive split, a great divergence. The one thing you have to understand about this economy is that it's become K-shaped. It's literally splitting in two directions. On that top branch of the K, you've got higher income households. Their investments are doing well, and they're still spending. But on the bottom branch, a lot of families are really getting squeezed by rising costs and debt, forcing them to pull back. And this isn't just an interesting fact, it completely changes the game for which companies are going to win and which are going to get left behind. So what's actually causing this big split? Well, it really comes down to two gigantic trillion-dollar engines running at full speed at the same time: new fiscal policy and the AI supercycle. And where they crash into each other? Well, that's where all this instability is coming from. Okay, first, let's talk engine number one, government spending. I want you to imagine a hypothetical fiscal stimulus bill, let's call it the OBBBA for short, that pumps a staggering $4.5 trillion into the economy, mostly through very specific tax cuts. A cash injection of that size is an absolute game changer. It's not just a little nudge, it fundamentally reshapes the entire landscape. And here's the key. It's not spread out evenly. Just look at who really benefits from a stimulus like this. Changes to interest deduction rules? That's a huge lifeline for smaller, more indebted companies. Letting businesses immediately write off their R&D spending? That's like a shot of adrenaline for tech and biotech firms. This isn't just spraying money around. It's a very targeted injection of capital. Now, at the exact same time, we have engine number two firing on all cylinders, the AI supercycle. The amount of money pouring in AI right now is just astronomical. But as Vanguard points out here, there's this growing concern about AI exuberance. You know, the hype is absolutely off the charts. The big multi-trillion-dollar question is whether the future profits can ever live up to today's sky-high valuations. Because if they can't, all that optimism could flip to some serious downside risk and fast. And this brings us to a really fascinating and critical bottleneck for the entire AI boom. It's this collision point where digital ambition slams right into the hard limits of physical reality. Here's the deal. For all of its futuristic digital magic, AI is an absolute energy hog. It has a very real, very physical, and very large appetite for electricity. Every query, every model being trained, it all happens in these massive data centers that are putting a strain on our power grid like we've never seen before. And the scale of this is, well, it's just mind-boggling. Look at this number. Projections show that by 2030, just data centers alone could be eating up 945 terawatt hours of electricity a year. Now, to put that into perspective, that is roughly the same amount of power that the entire country of Japan uses today. This is a monumental leap in energy demand. So here's the real kicker, the big bottleneck. You can invent the world's most powerful AI chip, but it's just an expensive paperweight without electricity. And right now, if you want to build a new data center in a major hub, the wait time to just get connected to the power grid can be 7 to 10 years long. This is not a software problem you can just patch. It's a hard physical limit. And it begs the question for the entire AI revolution, can our physical world actually keep up with our digital dreams? So let's pull all these threads together now. We've got the K-shaped consumer, that huge fiscal stimulus, and this massive AI power crunch. How does this all shake out across the different sectors of the market? Let's take a look. First off, just get a load of this concentration. The information technology sector now makes up almost 35% of the entire S&P 500. It's a total winner-take-all situation, which means that what happens in tech absolutely does not stay in tech. It ripples across the whole market. But even inside this one giant sector, there's a really interesting story unfolding. It's really become a tale of two techs. On one hand, you have the companies making the picks and shovels for the AI gold rush. Think semiconductor makers, hardware companies. They're booming. But on the other hand, you have some of the classic software companies who are actually facing a huge threat as AI starts to just build their tools right into its own platform, basically eating their lunch. So when you put it all together, what does the 2026 scorecard look like? Well, this table lays it all out. You can see the clear outperformers there in green. Healthcare, communication services, and industrials are all expected to lead the way. And then you have the underperformers in red, like utilities and real estate, that are facing some pretty serious headwinds. Let's quickly touch on why. Healthcare is seen as that classic defensive play, but with a growth kicker from new biotech. Communication services is a direct bet on the whole digital economy. And industrials? Well, they're set to benefit from both the OBBA stimulus and the physical build-out of all those new data centers we were just talking about. Now, here's a fascinating one. Even inside a struggling sector like real estate, there's a big split. You see, private real estate is having a really tough time. Valuations are messy, credit is tight. But public REITs, those are the real estate companies you can buy on the stock market, are often in a much, much stronger position. They have cleaner balance sheets and better access to money, which means they're ready to pounce on opportunities when the market turns. All right, let's bring it home. For our final section, let's look past the giant tech headlines and talk about where strategists are actually seeing some really compelling opportunities for 2026. So where should we be looking? Well, let's start with small cap stocks. And this chart right here shows their secret weapon. Just look at the difference in how they're financed. Small caps have a huge chunk of their debt in floating rate loans. Now, that's been painful while rates were high. But the moment the Fed starts cutting rates, these companies get immediate and massive relief. You combine that interest rate sensitivity with the targeted benefits from a potential fiscal stimulus, and you've got a really powerful recipe for a small cap comeback. Another potential bright spot is looking outside the US. The forecast for emerging markets in 2026 is actually pretty exciting, with a predicted 16% total return. So why the optimism? Well, it's a powerful 1-2 punch of their own central banks cutting interest rates and a potentially weaker US dollar. For anyone worried about having all their eggs in the US tech basket, this is a pretty compelling way to diversify. So I'll leave you with this final thought. In a market that's being completely defined by this wild collision, a massive government stimulus package crashing into a technological supercycle, where does the real opportunity lie? Is it in the dazzling digital world of AI models and software? Or is it in the gritty physical world, the companies that are actually building the power plants, laying the fiber optic cable, and making the stuff that allows it all to happen? That right there is the central question for every single investor heading into 2026.